Good morning, good afternoon, good evening, depending which time zone you are. Thanks for joining our tax working group. Happy New Year. This is our first session for 2025. Well, today we're going to talk about FATCA, the CRS Common Reporting Standards, and CARF, the crypto reporting framework. I guess the genesis of this were some conversations I was having one-on-one with other members of the tax working group, especially with last year there being a bit of a bull run when it comes to Bitcoin anyway. So we thought, well, definitely CARF is on the radar. It was getting a lot of special attention. And we thought we'll bolt on CRS and FATCA, and here we are. So just to set expectations, this is not going to be a particularly deep dive. What I'm hoping you'd walk away with would be an appreciation of what the key drivers of each of these reporting frameworks are. And if it is that you're interacting with clients or you have situations, you can spot what the key issues would be, and particularly any red flags, which we'll come to later on. So just a couple of slides setting the scene. The first of which would be the key players shaping global tax policy, most of which are pretty obvious, but I just want to call out the FATF, the Financial Action Task Force, in 1989. They're really the voice behind a lot of the anti-crime elements, so the anti-money laundering initiatives. And when you're looking at CRS in particular, I think it's super important that you look at the CRS rules or the CRS directives in tandem with the FATF. So they both work synergistically with each other to give a more comprehensive view of CRS in particular. CRS is pretty comprehensive regulatory framework. Another key player I want to call out is France. You know, in the English-speaking world, sometimes we forget about it, but France is perhaps arguably the driver behind these types of initiatives in the EU in particular, and more broadly within the OECD. Remember that France hosts the headquarters for both the OECD and the FATF offices. And because of the structure of the French economy, there's a heavy reliance on the public sector. And so they have, let's say there's a large degree of self-interest in being as efficient and as effective as possible in terms of revenue collection. And last year in the tax world, I think France really had some headlines for, at least within certain political spheres, proposing citizenship-based taxation, which is what the US and Eritrea have. So whereas in other jurisdictions it is possible to sever tax residency by moving abroad and taking certain steps, generally speaking with the US and Eritrea, unless you're going to give up your citizenship, it's not possible to break free of the tax net. In France, at least some elements within the French political structure have signaled that that's the direction that they want to go in as well. US, we don't need to say much about the US. The US is driven by American exceptionalism. So they do what they want. The US does what it wants. It helps having the world's reserve currency, which we'll see plays a really important role when it comes to FATCA. And they get involved in other multilateral initiatives to the extent that it promotes American interests. Otherwise, they kind of don't get involved at all, as you'd see with CRS. The UK, when people think of offshore, people tend to think of Switzerland. But when you look at the UK, you have to remember it's not just the city of London, but there are a lot of other dependencies and jurisdictions connected within the wider United Kingdom. So you're thinking of the Channel Islands, you're thinking of Guernsey and Jersey, you're thinking Isle of Man, you're thinking of British Virgin Islands, you're thinking of Caymans, etc. And when you look at them collectively, it's probably the biggest offshore network in the world, the UK plus its dependencies. So I just want to kind of call that out, and it sets the scene for where we're going to go next. So we're looking at the automatic exchange of information. There's, of course, information upon request, but we're looking specifically at the automatic exchange of information. I am not going to get into the DAC stuff. So these are the European directives, and it's really something that has meaning within the EU, which we could probably touch on at a later point in time, but I'm just going to stick with FATCA, CRS, and CARF because our focus really naturally is going to be within Asia Pacific in general. So, yeah. So rough outline, rough framework. So let's start with FATCA. What is FATCA? There's so much misunderstanding around what FATCA is, a financial account tax compliance framework. It was passed. It was actually not a complete piece of legislation on its own. It was passed as a rider or like an attachment, is a rough way of explaining it, to the Hiring Incentives to Restore Employment Act, which was under President Obama in 2010 and came into force in 2012. And I mentioned that because that explains some of the unintended consequences. It was a rider. Perhaps a lot of the legislatures, the congressmen, members of the legislative body who got involved in it didn't actually read it. And so even today, we're dealing with the unintended consequences and their movements to and legal actions being taken every once in a while to either reverse it or to deal with some of the issues coming from it. But remember, it's not a tax. It simply set the framework for information exchange. How did it do that? So the US went around the world and signed bilateral agreements with jurisdictions all over the world. And some jurisdictions that you didn't think would sign actually did sign. So, for example, China. Of course, it's not enforced right now, but, at that point in time, everyone was more or less okay to sign. And so you signed a bilateral instrument with the US. And then domestically, so let's say in Singapore, Indonesia, Australia, New Zealand, the local legislature would then pass legislation that would set aside the domestic bank secrecy laws. And therefore, what they would do is mandate their domestic financial institutions to go through their books, look for certain indicators, and we can get into that if that's of interest, to identify which account holders may be US exposed. And once you identify those potential US exposed individuals or entities, then depending on whether you're Model 1 or Model 2 jurisdiction, you report it either, well, like in Singapore, you'd report the list to the Inland Revenue Authority of Singapore, who then sends it on to the US government. If you're Model 2 jurisdiction, like one of the other, then you would send it directly to the US government. So that's essentially what it is. And then for US taxpayers themselves, there's a bit of the rules that were enacted which required self-reporting. So that's it generally. Then you ask the question, well, why did all these jurisdictions sign up for FATCA? Like, what's in it for them? Well, perhaps it was at that point in time the promise of reciprocity. Well, we tell you which Americans are banking or have financial assets in our jurisdiction, and you tell us, which Indonesians or Singaporeans or whoever may have financial assets in the US. So there was a promise of reciprocity, but arguably, more importantly, there was a bit of a threat. Not a bit of a threat, there was a threat. So if it is, depending on what the nature of the situation is, there's a risk that if the jurisdiction, and particularly the financial institutions in the jurisdiction, were not playing ball with the US, then there's a risk of some sort of withholding. So a 30% tax, or worst case scenario, being locked out of the US financial system. And given, as we said before, the US dollar is the world's reserve currency, if it is that you have a financial institution that seeks to do business internationally and you're unable to effectively deal in US dollars, you might as well not have an international financial institution. It doesn't work because you need to be able to do US dollars. So there was a reasonable incentive. And to date, I think maybe somewhere between 110, 120 jurisdictions or nations have signed up. Many aren't, they may not have carried it all the way through, so it may be suspended or it may not be operational, but at least the initiative was undertaken. What I want to also call out is that this is a big shift. When you look at the history of international cooperation and you start back in the 1980s, the sentiment was really the opposite. The generally accepted sentiment is that no nation has an obligation to help another country collect their taxes. That's your problem. That's not my problem. Everybody kind of handles their own situation. We don't need to get involved in each other's business. But I think perhaps the end of the 1990s, there was a pivot. There was the OECD Harmful Tax Practices Project. There was also, for those who remember or who are old enough who remember the Liechtenstein leaks as well. And there was this growing awareness that, hey, these offshore jurisdictions were sometimes not being ethical or playing fair. We came into this new century. Of course, we had 9/11. And with 9/11, we saw US domestic law being tightened under the Patriot Act because there was the belief, and this helped lead to FATCA as well, the belief that some of these offshore jurisdictions and these unregulated financial institutions, they were helping organizations or groups of individuals who were up to no good. They were nefarious in their motives and intentions. To deal with terrorist financing, that created an additional motive to pivot from what was general international sentiment. We don't get involved in other people's business to we need to work together to deal with this. And I would argue that this all culminated in 2007, not with 2007, 2008 with the GFC. That did help. But 2007, there was an individual who would go down in international tax history. His name is Bradley Birkenfield, a US citizen who was working in Switzerland for UBS. UBS, for those who don't know, was and is the largest Swiss bank. He, for whatever reason, he had a problem with his employer, his former employer. He either quit or was fired, depending on which story you believe. And he's a US citizen, so he jumped in a plane, he returned to the US, and he walked into the DOJ office. The DOJ is the Department of Justice. And he said, my name is Brad Birkenfield, and I can prove that Swiss banks are helping US citizens not avoid, but evade taxes. And here's my proof. And he became one of the most well-known whistleblowers. And as a result, and this was well-timed given we dealing with a great financial crisis, then the momentum was definitely set and the political will was there. What we had is, it was unprecedented because, of course, up until that point, Switzerland was known for bank secrecy. And not even the Nazis could break Swiss bank secrecy. Yet we have the US government putting pressure on them. And for the first time in hundreds of years, it happened. Switzerland had to capitulate and they had to turn over lists, not just lists of US exposed account holders, but they paid huge penalties that were so big that some financial institutions that were in business, venerated brands and names in the Swiss banking landscape, in business for hundreds of years, they had to pack up shop because the penalties were so great and they were insolvent. It was unprecedented, is the word. And with that, you had this wave of public sentiment on the back of the difficulties of the 2010s that, you know what, even though someone may be legally avoiding taxes using tax planning opportunities, it seemed to have negative connotations. And politicians especially were up in arms against those who were not paying their fair share. We remember the Panama Papers, Pandora Papers, Paradise Papers, or whatever else. There were lots of leaks and high-profile individuals who were called out for perhaps not breaking the law, but for not paying their fair share of taxes domestically. As I mentioned, looking at Asia Pac, most of Asia Pac has signed with FATCA. There are, most of the key jurisdictions that we deal with are involved with FATCA, the Model 1 or Model 2. We discussed the implications for governments who have signed the bilateral agreement, financial institutions, and then suddenly everyone, when at that point in time they were opening accounts, they had to declare whether they're a U.S. person or not. And if they were a U.S. person, given what happened to Switzerland, a lot of financial institutions elsewhere in the world got really scared. And they said, well, here's the deal. Let's just not deal with anyone who we suspect as being US exposed. Not because we're doing anything that was not correct, is that the compliance burden of FATCA seemed so onerous at that point in time that they thought, well, there's a high risk of us getting this thing wrong. And if we get it wrong and we don't report someone who turns out to be a tax evader, we can get in serious trouble. Let's just not deal with anyone who we believe to be US exposed, given the certain US indicators that we had to look out for. In terms of loopholes, The most popular, I guess, evader when it came to FATCA is a billionaire called Robert Brockman. I think he passed away in 2022. I think he owed the IRS something like $2 to $3 billion. He's probably one of the largest individual tax evaders in U.S. history, arguably. They say that he used a loophole, but actually he didn't. When you actually look at it, he created offshore companies. He identified them as financial institutions, so he identified them as FFIs. He got GINs for them, the global intermediary identification numbers, and then he declared that there were no U.S. shareholder, there were no U.S. persons, there were no U.S. account holders. It's not a loophole. He just straight up lied. When you look at FATCA literature, his name pops up, but in my opinion, it's not a loophole. He just straight up lied. And one of the issues is reciprocity. Because remember, we said that some jurisdictions may have signed up for reciprocity. Generally speaking, the U.S. does not exchange information. They receive info, but they do not give for a number of reasons. But there is a list of just if signed between 110 and 120 FATCA agreements with various countries around the world. But according to the U.S. government, there are only 50 countries that they would automatically issue information to. These are basically the closest U.S. allies, as you'd imagine. That's a bit of an issue for certain governments who expected it to go both ways. Another problem is people who are lying on their returns, because part of it was that U.S. exposed persons supposed to declare in this new form of 8938 whether or not they have accounts outside. And if you just don't declare it and it's in a jurisdiction that for whatever reason the bank doesn't declare it, then there'll probably not be an easy way for the government to figure it out. The key loophole, or the key, for the want of a better word, loophole, I would say would be those who use jurisdictions that did not sign up with FATCA. And as you can see from the map, there are quite a few who didn't sign. And even within jurisdictions that signed, within a country can have various tax jurisdictions. For example, the taxes in Labuan, it's a special carve out that's different from the rest of Malaysia, or Batam for Indonesia. Similarly, for Norway, there's certain islands in the North Sea that aren't part of FATCA, even though Norway has signed FATCA. So if it is that someone finds a structure in a jurisdiction that's been excluded, then potentially you've found a loophole, but otherwise it's all in. So then a few years later, so FATCA was created or signed in 2010, went into force in 2012. A couple years later, you have CRS, Common Reporting Standard, which you can consider to be FATCA on steroids. So it took even a lot of the jargon, it copied and pasted a lot of the structure of FATCA, and we now have CRS. So when you're reading both sets of guidelines, they're reasonably similar. FATCA, the intent of FATCA was to look for U.S. account holders outside of the U.S. The intent of CRS is, well, countries, again, they sign either multilateral instruments or bilateral agreements. And the intent is to look for account holders who are exposed to other CRS jurisdictions. In a way, it's easier with the U.S. because then you say anyone who is a U.S. citizen or permanent resident who has certain U.S. industries, chances are I need to report them under FATCA. CRS there's still a lot of uncertainty in certain areas of CRS because it's not so easy to see. For example, I may have a U.S. or a U.K. passport, but I live in Singapore. So technically, if I open a bank account in, let's say, Indonesia, the Indonesian bank should report me to Singapore as well. But sometimes that may not be readily apparent. And sometimes the frontline staff don't look for where someone else may be resident. They just look for nationality or resident, some sort of residence card that they easily see, but they don't ask questions and sufficiently probe to find out all the jurisdictions, because in the age in which we live, it's quite common for someone to be exposed to several jurisdictions simultaneously. This is not unusual. Again, it runs in parallel to FATCA. The government signed agreements with each other. They passed domestic laws to set aside bank secrecy regulations. They require domestic financial institutions, and not just banks, but like insurance companies, investment houses, to look at structures, to look at account holders. Whereas before they were asking, are you a US person or not? They should be asking, where are you tax resident in the world? And therefore using whatever their framework is for reporting to each of those jurisdictions that this person has been flagged as resident. So yeah, 109. Again, it's probably a little bit more than FATCA. Again, between 110 and 120 jurisdictions have signed up for CRS. It's just a list, but it's a moving target. This is probably, I did this last year, so it's probably outdated by now. Yes, there are loopholes from CRS, but like FATCA, the only real loophole is using a non-participating CRS jurisdiction. In our neighborhood, I don't believe that the Philippines has fully enacted as yet. But the biggest elephant in the room is the US. And that kind of brings in, there's a certain trust company that's been in the news recently. I'm not going to call their name. If you know who they are, big in Singapore and Hong Kong. And according to the release from the US Department of Justice, so they're under investigation by the US government, they were marketing to high net worth individuals that they can avoid CRS with certain structures. And one of the more popular structures that they were offering to the public is setting up in the US, so a US structure, because the US is not a part of CRS. Obviously, that came back to bite them, because the US does have a history. Again, even though you may not be breaking their rules, if you're breaking somebody else's rules, they might get involved. And more importantly, from a US point of view, the US government believes that they weren't just helping people avoid CRS, but they were also helping people avoid FATCA. So US taxpayers avoid FATCA. So, I guess they're looking at everything as a result of that. So it's really about non-participating jurisdictions and leveraging those, whether for FATCA or for CRS. But for CRS, I've heard so many fiduciaries, so many individuals peddling structures that they propose are CRS invisible. So you can legally hide from CRS, and as well as a crypto asset, a CARF as well, the crypto asset reporting framework, which we'll touch on next. I have them here, but I guess the two I would call out would be, well, in Singapore, there was a major case last year. So summer, was it 2023 or was it 2022 by now? I think it might have been 2 years ago. It's been a while now. So it was a huge case of money laundering. And many of the key individuals in that case, they were Asian nationals or Asians by birth, but they had passports from other jurisdictions that offer citizenship by investment. And it's added to the stigma of that, because, what is alleged, these things are under investigation. What is alleged is that sometimes when you do invest a certain amount of money and you get a passport from one of these jurisdictions, they also give you additional documents that suggest that you may be resident there. You can get proof of address, for example, allegedly. So within the CRS world, this may lead to some sort of deception, as in you telling the bank that you're resident in whatever island it is, but that's not your primary residence, and you've conveniently omitting where you really are spending time. So there's a bit of misleading. So that's an issue. To me, that's not a loophole. It's just, it's just being dishonest. Another one, this is my most recent one. Both Singapore and Hong Kong have companies limited by guarantees. And there are attorneys or, legal professionals who argue that depending on how those are structured, you can avoid CRS. I've had a look at it. I've spoken to other professionals that have looked at it. We don't think so, but they think so. And that's the kind of thing, where people try to game this system. Whether or not it's accurate or not, I guess we can have a debate on that. But the CRS rules, when you look at them again, that's why I emphasize you look at CRS rules in tandem with FATF rules. And it's a pretty comprehensive body of guidelines. And it's really hard to find a proper loophole in any of those, except when it comes to just non-participating jurisdictions. CARF, the crypto asset reporting framework. This is a new kid on the block. I think we have something like maybe 63, 64, 65 jurisdictions that have signed up to it. There's a lot of uncertainty because unlike FATCA and CRS, you have financial institutions that have been basically, as my friend Mark likes to say, they've been deputized by the tax authorities. So basically, you've turned banks, especially, into tax enforcement institutions. And we all know that from the horror stories from our clients, stuff being frozen. Every year you have to fill out new KYC forms, et cetera, because banks now see it. You can argue whether it's right or wrong, but banks now see it as their responsibility to ensure that none of their clients are running afoul of any tax laws. And if you are, if they suspect you are, they're going to kick you to the curb. They don't want to deal with you. So that's the reality. But with CARF, it becomes more difficult because if you want to use that model, who are you going to deputize? Which institution is it? Are you just going to look at crypto exchanges? But there are way more intermediaries in the crypto space than just the regular exchanges that you see in the news every day. So it becomes really, it's obviously a completely different model. So CARF, I think, still needs to be refined and defined. But essentially, what they're trying to do is saying, okay, when crypto is being stored somewhere, you're not going to find out, you're not going to know. So forget it. But what you do is you look for where there is an actual exchange. So when there is an exchange, so someone is doing crypto to crypto, crypto to fiat, whatever it is, whoever or whatever institution facilitates that exchange, they've defined as a CASP, a crypto asset service provider. Okay, so now we have someone to point at and we have someone to pick on and say, whoever you are, wherever you are, however you define yourself, however you label yourself, if you in any way facilitate an exchange, we're going to call you a CASP. And of those CASPs, there's certain subset, I guess, or most of them will be RCAPs or reportable CASPs, so reportable crypto asset service providers. And those are the ones that we want to make responsible for reporting. So if it's peer-to-peer, you probably, I meet one person or Mitash and we just exchange crypto or we do an exchange, or it's hard to catch that, right? But if you use any sort of intermediary, that's the opportunity that the authorities see. This is how it is in theory. The devil is always in the details. So when it gets rolled out across the various jurisdictions that have signed up, that's when we'll see how it would really play out. But in principle, that's how it works. And as for those who are really into crypto, you're already seeing all the problems with that. And yes, you're right. There's going to be a slew of problems. So, yeah, the jurisdictions that have signed up. So that's it. That's it in terms of a brief introduction to FATCA, CRS, and CARF.